You hear the word every day. It's on the news, in your feed, and it's the biggest driver of wealth for the world's richest people. But what actually is a stock? Is it just a fluctuating number on a screen, or something more? Today, we're stripping away the jargon to show you exactly how stocks and market work by following two people, an entrepreneur named Mr. Smith and an everyday saver, let's say named Sarah. This is Mr. Smith. He owns the Bread Box, the best bakery in town. He wants to expand and open 10 more shops, but he needs $1 million to do it. Now, Mr. Smith has a dilemma. Even if he could scrape together that $1 million from his personal savings, he knows that's a massive risk. If he spends every cent he has, he'll have zero cash reserves left. If a delivery truck breaks down or the price of flour spikes, his whole business could collapse because he's cash-strapped. Now, Mr. Smith has a choice. He could take a massive loan from a bank, but then he'd be buried in interest payments. Instead, he decides to go public. Going public is the process of turning a privately owned business into one that anyone can invest in. It's like inviting the whole community to become co-owners. By going public, Mr. Smith isn't borrowing money. He's inviting partners. He is trading a piece of his ownership for the cash he needs to grow without the burden of a bank debt. To do this, he creates stocks. So, what exactly is a stock? Think of Mr. Smith's company like a giant pizza. Right now, he owns the whole thing. By creating stocks, he is slicing that pizza into 100,000 tiny, equal pieces. When you buy a stock, you're buying one of those slices. You aren't just betting on him, you legally own a percentage of the ovens, the secret recipes, and every loaf of bread he ever sells. Mr. Smith keeps 50,000 slices for himself to stay in control and offers the other 50,000 to the public for $20 each. And when those shares sell, the math lines up perfectly with what he needed earlier. 50,000 shares times $20 equals $1 million, the exact amount he needed to open 10 more shops. This event is called an IPO, or Initial Public Offering. And this is where Sarah enters the story. Enter Sarah. Sarah wants to grow her savings. She sees Mr. Smith's $20 shares and asks, "Is this a good deal?" She looks at the bakery's earnings per share. If the bakery makes $100,000 in profit and has 100,000 shares, each share is earning $1. Sarah decides that paying $20 to own $1 of annual profit is a smart move, especially since she expects those profits to rise as Mr. Smith opens more shops. Sarah buys 100 shares. She doesn't buy them directly from Mr. Smith at the bakery. She uses a stock exchange. Think of the exchange like a giant, high-tech flea market. Today, this happens on apps on our phones in milliseconds, whereas it used to happen with people shouting on a floor. It doesn't set the prices. It just provides the platform for buyers and sellers to agree. If more people want to buy Breadbox stock than sell it, the price goes up. If everyone starts selling, the price goes down. 2 years later, Mr. Smith's new shops are a hit. Sarah's shares are now worth $45 each. If she sells, she makes a capital gain of $25 per share. But Sarah holds on because of dividends. Mr. Smith is so successful that he shares his extra profit, sending Sarah 50 cents for every share she owns. As a thank you for her investment. And that's called a dividend. But what if a new gluten-free trend hits and no one wants Mr. Smith's bread? If his bakery fails, Sarah's shares could drop to zero. This is the risk. To protect herself, Sarah doesn't put all her eggs in one basket. She buys an index fund, basically a giant basket that holds tiny pieces of hundreds of different companies all at once. It's like instead of betting on one business, she's spreading her money across an entire slice of the market. She doesn't have to pick winners. She just owns a little bit of everything. This is called diversification. If one business fails, the others keep her portfolio growing. In short, stocks are pieces of ownership. Companies sell them to grow without burning their own cash or taking on debt. And investors buy them to build wealth over time. It's not a casino. It's a way to own a piece of the economy. Thanks for watching. Hit subscribe to stay financially literate.